let's jump into this piece from the conference board. How's everybody feeling?
We did cover consumer sentiment a couple weeks ago with Jay. We talked about some information that came out from the New York Fed. But this conference board is a little bit newer, and this was the oldest data at the time. So I wanted to give a little bit of an update. Conference board had consumer confidence going up, really surging up. I think they used a lot. What is it? Bounced back, rebounded. That was the strong language they used in their headline. Is this a vibe shift for the economy? I would kind of add to this. So in addition to consumer confidence jumping up from around like 100 to maybe looks like 107 or 110. I don't know. I don't have the specific number, but it bounced like maybe like 10% ish. The important point is that it has gone up at a pretty good clip. And it is a sign that correlates or at least agrees with a lot of the information from other places, such as University of Michigan. They have consumer sentiment going up. The OECD, which is a kind of an international group, has U.S. consumer confidence ticking up slightly in their consumer barometer. I'll also add that a recently published report argues that same University of Michigan consumer sentiment survey, which is pretty big deal when it comes
to gold standard.
Yeah, exactly. Yeah. That actually should be a little bit higher than it is right now because they switched from phone surveys to internet surveys. And when they switched to internet surveys, the consumer sentiment tanked by like 9 points.
Oh, interesting.
So there's that structural issue that was related to the way that data was gathered. And it's a little bit nerdy and in the weeds, but the upshot is like we're a little bit more confident no matter if you're taking that into account or not. Like there's been recent increases in consumer confidence. Now, I want to do one more thing because we have a little bit more people are tracking inflation expectations. Now, that's something that we were just talking about.
Not a shock.
I think that is a particularly political partisan issue too.
Oh, yeah.
If you are Republican, you want to think, you're motivated to think that inflation is stronger than it is. There may be some nuance to that, obviously, but I would bet that is more of the case.
I don't think there's any nuance anymore. I think it's all been all been lost. It's just things are more expensive.
And I think that is kind of actually the
they don't even have to be more expensive.
Yeah, I know. Exactly. Yeah, you can just feel it. And that's what we're talking about right now. What do they feel? The expectations and kind of this feeling of inflation. It actually ticked up this past month from the conference board from 5.2 to 5.3. Now, that is an average and not a median. I say that because U of Michigan has their median at 2.7%, which is not 5.2%, and their average is I dug into the data a couple weeks ago. Their average for U Michigan is like 4.7 or something like that. So clearly there is a variance, and I would argue that the variance, at least at first glance, it seems like we are a lot farther apart between the high outliers and the median. It's because there are people that are like, yeah, it's going crazy right now.
Yeah,
we're in election season. That's my own opinion. But again, to look at the median here, so we've got 2.7. People from Michigan. You get from Cleveland Fed, it's 2.26. From the New York Fed, it's 3. From history, it's 2.4. That's the CPI. And then PCE measures it a little bit differently, so I can't really take that into effect.
Yeah.
But like all of these measures, including the PCE, show expectations going down. This is for annual inflation. So all of this, regardless of whether you're thinking it's high or thinking it's not, the expectations for inflation are decreasing.
Yeah.
And so that's like the bottom line upshot. I think this most practical takeaway. And then also this consumer sentiment generally is improving. So it's good news.
And on top of that, because I'd agree 100%, but we got also the chance of a recession. The perception of the likelihood has gone down considerably.
Wow, yeah.
Where it was, kind of peaking in like April and May of 2023. I mean, we're at a multi. This only goes back to July of 2022. We're at the lowest point of where we think that there might be a recession in the last 2 years. Which I'd love to see if this chart went back further and if there was like an absolute inversion and correlation of when we were least likely to think there'd be a recession. Is that the most likely time?
Oh, yeah.
But as I just wrote, Matt, when I was doing a write-up for our quarterly reports for the Gray Fund, I made a couple comments that, I don't really see... I see no fundamental reasons why there would be a recession in the near to medium term. Now, technically speaking, like as we've talked about before, like when the yield curve reverts, there are technical signs of where we could be heading towards a recession, but there's really nothing kind of fundamentally. And I'm not so much of a technician where I'm going to say, yeah, there were a recession just because these two data points are pointing in a direction when the data is so messed up over the last couple of years. But it is interesting, again, just coming back to sentiment, not what's going to happen or not, but the consumer, in general, the population, has to be more optimistic if they don't think a recession is around the corner. I mean, this better or worse metric here will show right here also. I mean, the better is going up. Family expected financial situation 6 months hence.
Yeah.
People are more optimistic. Now, is that politically? Because they think there's going to an election, or I don't necessarily think so, because I think people are just. Maybe it is because we didn't have the recession, and we're just dealing with the day to day, and we're like, you know what, we're all still here, we're all moving forward. Mm-hmm. As much as things are different, and we go and complain about the cheeseburger being like $25. The fact is, everybody's wages. I say everybody. The vast majority of individuals' wages have increased over the last couple of years. Not that a ton of people are like absolutely excelling, but people are absolutely surviving and are a little bit optimistic for the future, which is always a good thing.
Yeah, and just to kind of bring it back to our world of multifamily investment, I know this isn't a direct study of like apartment investment prospects, but I think it's relevant.
It is,
like
100%.
To me, like I said, like maybe the institutional investor is like far different from
what investor is going to be like, sign me up for whatever investment other than like bonds or gold if there's a recession around the corner, if the economy's in the dump.
Exactly. And I want to say, like, it almost feels kind of redundant to defend the relevance of this data, because it's like if you're pitching an apartment investment to an investor, well, like, there's going to be a mood that's going to be a factor in their decision. And like they may deny it, and it's all about, but like the way that you approach any data, you're going to have to bring your, I hate to say it, but like your gut to it. It's a small factor, maybe. But
and some people are just sort of like, they're done being on the sidelines.
Yeah.
And their gut is saying, maybe it's mixed with them with a little bit of FOMO.
If you are, and that's what I want to say too, is like, if you are, investment involves speculating on stuff that is not sure. You don't know, nobody knows the future, so you're going to have to bring something that's not necessarily completely fact. You have to do that extrapolating, and that extrapolation it leads a little bit to the bias, to the sentiment, to the mood, to the vibe, whatever you call it. But I think it's relevant to know where people are feeling, and there's some accuracy too. That's I throw away feelings too because they're stupid, they're dumb, right? They're not facts, but feelings,
they're tools. I don't think
they can point to where the facts are going. You may be able to see a bump in sentiment that precedes, or a decline in sentiment that precedes a recession or a boom time. That's
I made a really bad video about 3.5 years ago about emotions in investing. If anybody wants to see a very much OG Gray Capital YouTube video made in my basement,
it had some tactical usefulness for sure.
That's what I'm saying. If you use it as a barometer and as a meter, and you don't just put all the weight on it, it can emotions are powerful. We can perceive quite a bit. Now, they can sway your thinking and reasoning to ways that are outside of the reality, but if you keep it in check, it can be an incredible tool.
So totally agree.
So while things are looking great, let's talk about a little update on the doom and gloom of the market absolutely crashing. We published a couple research reports too, in fact, on loan maturities in the multifamily industry and the risk that they pose. Now, while some people were calling for absolute, Armageddon, I think ours was a little bit more nuanced and really just laying out the risks. And I think we were very spot on identifying what those risks were and some outcomes. And we said, one outcome is that most of these loans will be extended to where basically the the lender is saying, we know that the value is way low. We know you're having problems, and typically that note's coming due in 6 months. But man, we don't want to deal with your problem property. We don't want to take the keys from you. And in fact, our analysis shows that maybe interest rates will come down, and you're a client of ours. Let's give you another 6 months. Let's give you another 18 months maybe to see if this whole situation just solves itself. And if we just kind of don't look at the price for a while, the next time we look, all the numbers will work. And that has essentially become policy for all lenders across not just real estate, all asset classes. The Federal Reserve